Hey, folks, welcome to verifiedinvesting.com. My name is Gareth Soloway here with another deep dive. And in this video, what we're going to do is we're going to explore the currency markets, taking a look at the dollar, the euro, the yen, and the pound. And it's interesting because what we're seeing here is that most currencies, major currencies, are set to strengthen against the dollar on the charts. And this is, again, just purely technical analysis based, except for the yen. The yen is showing signs of continued weakness, potentially breaking out in terms of weakening further against the dollar. And that, again, could be related to their debt to GDP numbers being around 240% versus the US only at 130%. Now, listen, 130% is not good. That's very scary. But again, it could explain why, again, the yen is looking like it's going to weaken further against the dollar. In addition, don't forget, they had the elections recently, and more of a dove was elected, meaning more lenient on monetary policy. And that could also be shaping the outcome. All right, into the charts we go. Let's start with the DXY. The DXY is the dollar versus a basket of currencies. So it gives us a general view of how the dollar is against those currencies. And what we've seen lately is honestly a lot of sideways chop in the US dollar. You would look at this and say it's a bit of uncertainty. What I like to do is I look at why did we bottom out down here? Like what was here? There must be something technical. And then same thing when you zoom out, like why did we top out here and have this big drop? What on the charts was guiding us to that? So let's do this. Let's take a trend line and we're going to go to the weekly chart and go all the way back here to the 2008 crisis, right? The financial crisis. And what we see here is there's a trend line, right? If we take our lowest points here and we connect it through, interestingly enough, look at this. We literally get our low from 2011 right there. That again means that we tagged this trend line here in 2021, right? 2020 to 2021 before that big run in the dollar. And then we've come back into that level. Now, this is a longer term trend line. We can even extend it further out. And you can see again, there's no other trend lines or pivot points on the US dollar that even come close. So what this tells us is this is a major trend line for the dollar, meaning that as of now, it is holding. As we can see, it's bounced off this level. But if this were to break, it would break a major uptrend in the dollar that's lasted since the financial crisis. And the reason why that's a negative here is that once you start to see that breakdown, it's a slippery slope, right? The dollar and de-dollarization would likely accelerate over the coming years and even the next decade. All right. So we've now found why we have our support level here. Now, what I want to do here is look and see, okay, well, why or where are we looking at? I mean, what happened at these pivot points, right? And we could zoom all the way back. I mean, here we're going into the 80s, right? This is when, remember, Volcker was raising interest rates massively and the dollar was just ripping up because our monetary policy was so stringent. And then obviously it collapsed back down. This is the crash of 1987 during this period right in here. That's actually kind of right where we bottomed out on the US dollar before kind of going into more of this sideways and then the uptrend from the financial crisis. By the way, this was your high on the US dollar just before the dot-com crash, right? And you can see what happened to the dollar. And by the way, that makes me think that if the stock market is at its highs and were to fall, we know monetary policy would get looser, but the dollar in response would likely follow. And you could see that happened, right? I mean, very clearly, you could go back to the dot-com highs on the dollar. And then once the economy collapsed because the dot-com bubble collapsed, and essentially the dollar collapsed as well. I mean, it didn't crash, but it just went into a steep downtrend, finally bottoming out in the financial crisis, right? And so what that tells us is if we look at the AI scenario, right? If we look at AI and say, okay, this is most similar to what happened with the internet, right? The internet changed our lives. AI is supposed to change our lives. Whenever it does top out, whether it's in a month, a year, whenever, it likely will cause a weakening in the dollar because that's what we saw after the dot-com, right? And you can really extrapolate history to kind of project out the likely scenario. Notice I'm saying likely because nothing's 100% in stone, but the likely scenario for the US dollar would be further weakness. Okay, so that's where we are at this point. And again, just looking at this, if I draw some trend lines in, this is what I would do right here. You have a pretty clear down sloping trend line. You briefly pierced it right there, but that's why we had this high right here. Notice right over here, you never really had a close above this area. You pierced it, But again, notice that right there. And so this gives us kind of a max upside on the dollar back to 108. I don't think it's going to get there, and I'll tell you why. So if we look at the dollar here, there's a very clear base of support right here, right? I mean, again, you can basically align it with a trend line. And what we could see is if we put a trend line in here, it essentially aligns pretty much perfectly, and we can adjust it down slightly, right? So what we have here, as the dollar dropped in 2021 into 2022 into early 2023, we had lows, right? The dollar kept bouncing, hits, bounce, hit, bounce, hit, bounced, and even over here, hits and bounces, and here it hits and bounces. Finally, after 1, 2, 3, 4, 5, on the sixth hit, it broke, and then this became resistance and then resistance. And so the idea is when we're looking at max upside on the dollar, where do we think it's going to be? Is it here? Well, I mean, only if it's able to really get above and confirm above here. But right now, this is a very clear major level of resistance because we could see how good it was at holding support. And then once it's broken, right? So if 2, 4, 5 hits before it broke, we've only had on the other side 1, 2. This would only be our third hit. So would probability favor a breakout or not favor a breakout? And the answer is probability would not favor a breakout, right? We would expect a rejection, and then we look at this lower area here. Now, when we look at this, we start counting how many times we've hit this line, right? And so the question is, would it break on the next hit? And in general, you look for more than 4 hits, right? So you look at, the fifth hit, the sixth hit, it's very likely to break at that point. And what we could see here is we had one hit. I'm going to assume this is just one hit, right? One hit. This is maybe 2 right here and here. And so 2 and 3. And then is this 2 hits, 1 hit, 2 hits? It's tough to know because these are so close together. Do they count as 1 hit or 2 hits? And this is where, again, technical analysis is part science, part art, right? And you have to understand that is there's nothing perfect. You're never going to know 100%, and you have to be okay with that. It's okay not to be 100% sure because, believe it or not, when you're not 100% sure, what do? Do you invest all your money, or do you just kind of inch in because you're not 100% sure? And what I at least do, and I'm sure you guys do the same, is when you're not sure, but you think something is pretty good, you invest some, but I don't go all in. It's people that go into trades and they're like, oh, this is the biggest no brainer. I'm just going to go all in on XYZ. It'll be pay me out $1 million in a day. That's where they get in trouble, right? Because they essentially don't have maneuverability when you put all your eggs in one basket. All right. So what we see here is we have potentially 1, 2, 3, 4, 5. So this would be the sixth hit if we combine these. So this is 1 and this is 2. So this would be 1, 2, 3. So this would be the fourth hit. So it's either the fourth hit or the sixth hit. The point being is it's getting towards that point where you'd start to want to be a little bit concerned that the US dollar would break down, right? And again, I think that's very, very important, right? And again, for me at least, that's important to understand is because I'm trying as a technician to decide, okay, well, will it get rejected here? But what if it hits here? And the odds would slightly favor. This is only 1, 2. This would only be our third hit. Even if you include these together, this would still be our fourth hit. So you've hit more times to the downside. Remember, whatever direction, right? If you have a trend line and you hammer on it over and over again, and then you have a level up here, this would be 1, 2, 3, 4. The odds would favor a break here because this would only be 1, 2, 3 hits. This would be the fourth hit right there, right? So again, it's just kind of tricky in that respect. It depends on which way it goes. But the point being is the in technical analysis, the more hits, the more likely you break a level, right? It's kind of an irony here because in technical analysis, the more hits of a trend line, it shows you that it's a significant trend line, right? It's like, wow, price is really respecting that trend line that I've drawn in. It's hit 3, 4, 5, 6, 7 times. But at the same time, the idea is, okay, it's a major trend line, but the more times it hits, the weaker it becomes. See that weird thing. So it's telling you it's major, but it's also telling you it's getting weaker and weaker at the same time. Just something to contemplate when you guys are trading. All right. So the dollar again, we'll watch and see, but essentially the easy way out here is just to watch for which direction it breaks. Do we break above 100.5 to 101 right up here on the DXY, or do we break and confirm below 97? You break and confirm below 97, you're likely headed to 89. Look at this, guys. You can see right down here, makes a lot of sense. This zone right in here, right? And again, you have all of this consolidation right through here, and these lows right here would be essentially your support line, right? And so you'd be going to about 89 and change on the dollar if you break down. And then if you break out to the upside, where would you go? Well, you're really, I mean, you'll have a little resistance here, but really at that point, this down sloping trend line starts to work its way out. All right, let's go on to the dollar yen. Now, this is basically we're looking at what's $1 worth in yen, right? So the idea is $1 right now is worth 100 and almost 153 yen. So that's essentially, it's telling you that $1. So if this chart were to go up on the dollar yen to 160, right? That would mean $1 would be the 160 yen. So it's actually showing you strengthening in the dollar, but weakening in the yen when this chart goes up. All right. Now, what's concerning here is you keep attacking, right? So same sort of thing. I've drawn my trend lines in already just to keep it easy for us, right? You have your pivot lows right down here, okay? And then you have your high pivots here. Okay, and we can see very clearly you hit it here, rejected, but look at how you're now starting to breach this level. By the way, this is the fourth hit, so it starts to get vulnerable right there on the fourth hit going in. And if we break through here, this is obviously a major breakout, right? I mean, the fact that this line has been respected for, basically since early 2020, mid 2024, is obviously a big deal. And so the idea is if you do break out, you might retrace, but then you're likely headed higher on the dollar yen. And that tells us that the dollar will remain relatively, assuming this breakout occurs, the dollar will remain relatively strong against the yen. However, if we go to the euro is not the same. Now, this chart looks like it's a breakout, but this is actually the euro in terms of dollars, right? So essentially, what's $1 worth? So for $1, essentially you get $1.15 of yen, right? And so again, very, very important to kind of see that differential there of how the euro, this would be the euro going up in terms of strengthening versus the last chart, the yen going up was weakening against the dollar. It's just essentially you can see euro USD versus the other chart here, USD JPY. So it's kind of inverse. It's just the way people look at these things, guys. It's just the nature of how most technicians view. But the point here is that essentially what we're seeing here is you are getting more bang for your buck, or the euro is beginning to strengthen more and more with this breakout. All right. And look at how significant this breakout is. On the yen, it was just going back 2 years essentially. On the euro, this trend line, number one, two, three, four, five, it broke out on the sixth hit. And so you can see how the more hits. So number one, look at how it abided by this. So it told us this was a major trend line, but it also is telling us that, basically, it's basically telling us that it broke out. It was weakening enough to breaking out. And just to let me explain this again, I want to make sure everyone fully understands. So for €1, excuse me, and I think I said this wrong. For €1, you're getting $1.15 in dollars, right? So essentially, the dollar is weakening. I hope I'm saying that correctly because again, that's very important. But the point is, again, this shows the euro is strengthening on the USD. Very, very important to understand that the euro is now looking stronger. I think personally, this is more to do with the independence of Europe starting to form, meaning that the Europe has been so dependent on the US as well as Russia. The Russian-Ukraine war has, in my opinion, pushed them to spend more on their military. That's stimulative for their economy. So in the near term, their economy is starting to rev up just while the US is starting to struggle more and more in their economy, right? And so it makes sense that the euro would be strengthening against the dollar. Okay. All right. So that's where we are right now. And if we go to the British pound, GBT, same sort of thing here. So you have this trend line. It doesn't go quite as far back on the charts as what we saw in the euro, but it's obviously further back than the yen chart. Here you have this beautiful parallel. Look at this. But again, here you have one hit, two hits, three hits. On the fourth hit, we broke out, we retested, broke up further, retested. Notice how it's staying above this zone. As long as the British pound stays above this, then this would be expected. You basically be expecting the British pound to strengthen further against the dollar. What would change my mind on this is if this chart broke back below here, right? If we break back below here, then it's an open area to kind of come back in. But as long as you hold here, the odds would favor a move to the upside. Same thing on the euro. As long as we hold this zone right here, this trend line, as long as we hold that, the odds favor an eventual move up of strengthening in the euro. And then likewise, this chart is the inverse of those, which again is a little confusing for you guys, I'm sure. But the idea here is that the yen going up in the dollar in terms of yen going up, that would tell us the yen is weakening against the US dollar. So suffice it to say here, guys, it's interesting because it's not like all currencies are setting up to based on chart analysis, based on pure chart analysis. Essentially, it's telling us Japan is the one that's going to struggle potentially more than the US. I think that has a lot to do with debt to GDP. However, debt to GDP could also be influencing, and debt and lack of control of spending is why the euro and the British pound are set to strengthen against the dollar. So there's a divergence going on here with global currencies. Overall, do I think that de-dollarization is coming and has started? Yes, there's absolutely no doubt in my mind. The fact that central banks and governments are loading up on gold, the fact that again central banks and governments are buying less treasuries. I mean, like all of these things are done to kind of get away from the US being so dominant and essentially being able to dictate policy and trade policy with all of these other countries. In fact, it's happening faster than we think in that respect. And that again, as the US should be concerned with that because having countries rely on you mean you have more power. But once they don't need to rely on you, guess what? They're going to stick to their guns a lot harder. It's going to be harder for us to move them in terms of policy that would be beneficial to the US. So interesting stuff going on here, folks. I'll tell you, this is very, very interesting. Thanks so much for tuning in. I'll keep you guys posted. Take care.